It's great to be here for this session with Sarah Williamson, CEO of Focusing Capital on the Long Term. And FCLT is an organisation which really brings together senior representatives from across the investor and corporate community to focus capital on the long term. I guess the clue is in the name. And I think there's a lot of alignment in the work that you do, Sarah, and the work that we do at A4S. Not that many organisations really bring together both that investor perspective and the corporate perspective. So really looking forward to the dialogue today and hearing more about some of the insights and perspectives that you're seeing. To get going, you've just released the latest FCLT Compass, which really sets out some of those trends. So I'd love to hear a bit more about some of the key insights from the Compass.
Great. Well, first of all, Jessica, thank you so much for including me in this session that you're doing. And I do think we have a lot of alignment in the work that we do. So we really appreciate that. As you said, we try to get investors and companies together and really think about what makes for long-term capital allocation and what gets in the way. Most people say they want to be long-term investors or long-term allocators of capital, but they often say somebody else is putting pressure on them. So what are the problems, what get in the way? And then one of the things we do is we measure that time horizon that people have. So we have done a Compass report, as we call it, for the last 3 years now, and we just released our most recent one about a week ago. And the idea of it is that we know investors, savers, have very long-term timeframes. They are probably saving for their retirement or their children's education or something that's long-term. They typically give their money to asset managers who invested in particular asset classes. And then that money eventually flows to the companies who need capital because, for example, they want to expand their business or enter a new market or whatever it might be. And so what we have seen for many years is that there's a gap there. So the investors tend to have a time frame, depending on country and so on, of about a dozen years. That's what they're looking for in terms of their mindset. But the asset classes they invest in tend to have a time frame of less than half of that. And then the companies, again, are longer term. So you see this sort of squeeze in the middle, which is that the connection point between the asset owners, the actual savers, and the suppliers of capital, if you will, and the actual users of capital, that there is this pinch point between them, which is the way our markets work. And so that's sort of an indicator of what we're working on. In a perfect world, there would not be that kind of pinch point. And this year in particular, what we saw is that in light of the economic uncertainty, the Russian invasion of Ukraine, and so on, that those timeframes got even shorter. So we saw both the investors and the companies' timeframes decrease by about 14%, which is very significant in a one-year timeframe. And that is sort of intuitive, which is when things get rough, people pull back. But it is not the trend that we would like to see.
And just picking up on that, as you highlight, really trying to find ways to lengthen those timelines is critical, particularly when it comes to some of the major environmental and social challenges that we face. With organizations, for example, setting net zero goals, often they stretched out the horizons, and certainly on the corporate side, but also on the investor side, because you've got a lot of investors who've also made those kind of commitments. And similarly, a lot of businesses thinking about the sustainable development goals when it comes to some of the social impact or the socioeconomic impact areas. But it sounds like from your survey, despite those commitments being made, you're not really seeing that flowing through, at least over the last year, into the timeframes for decision making.
That's right. And it may be that there's a lag in data and so on, but I think what we see, And the way we think, so first of all, let's put it this way. There's no such thing as short-term sustainability, right? Being sustainable and being long-term they're two sides of the same coin. And so having that long-term mindset is necessary to think about having a more sustainable business, whether that's around climate or around social issues or in pursuit of the SDGs or any other goals that people have. I think that what we're seeing is a sort of a push and pull, which is that there are many organizations, as you've said, that have made some sort of a long-term commitment, a net zero commitment or some other sort of commitment. But many of them haven't figured out how to get there yet. And part of that is just they're being ambitious. We would like to do this big thing and we don't know how to get there. But if we set a big goal, then our company will figure out how to get there. And I think that that's a very legitimate mindset. But on the other side, people are saying, well, wait a minute, how are you going to get there? What is your plan to get there? How do you put this into real plans? And so we've done some interesting work about company strategy and how often a company's long-term strategy really incorporates their sustainability strategy. And what we find, which again won't surprise you, is that many times you've got a company business strategy and you have a sustainability strategy, and they're not one and the same. And at least our strong view and our experience is doing a sustainability strategy or a transition strategy in a silo disconnected to the business is much less effective than having that be part of the business strategy as a whole and owned by the company as a whole, rather than just the sustainability people who have to fill out some, form to tell people how they're going to get there.
Yeah, no, that definitely aligns very closely with the work that we've done. We've certainly, if I think back, nearly a decade ago when we were producing some of the first guidance through our CFO leadership network, one of the areas that we looked at was enhancing investor engagement and that company investor dialogue. And that really came through very strongly there from the investor feedback was, there's no point talking about your sustainability activities on slide 50 of a 50 slide deck. It really has to flow as a golden thread through the discussion of strategy, KPIs, governance, risk, etc., all the way through to performance. And I think you've seen some of the developments in reporting driving that shift. But one of the things that we've released recently is a finance leaders barometer, and it gauges some of the views and the progress that organizations are making. And a little bit like your comment there around strategy, with a lot of organizations, I think you've had that shift to the commitment. So in the barometer, we found that 93% felt that it was really important for their business to transform decision-making to reflect ESG issues, but 19% reported that they don't consider ESG information when making decisions, instead relying almost exclusively on financial considerations. And I think that highlights the point you were making there, that organizations might have started to make the commitment and started to really work through how to integrate, but they haven't achieved that full integration, or there's a long way to go before it's fully factored in. And your Compass statistics, I think, underline that. Are you, from the work that you've been doing, what kind of progress do you think both companies and investors are making, and where are some of the key barriers?
So I think you've hit on one of the key barriers, which is, what are the metrics that actually drive value over time? And we've all done a lot of work on metrics. Is the and I don't like the term non-financial metrics. I like to think of them as pre-financial. So the question is, what are the metrics that maybe we're not going to hit your earnings this quarter, but are going to matter in the long run? So we all know what those things are. Things like employee turnover. Okay, that doesn't hit your financials this month, but probably over time it cuts your recruiting costs and retraining costs, et cetera. So I think of that, just as a simple example, as sort of a pre-financial metric. So one of the things that we have looked at in our work is companies that are both doing well on ESG metrics, we want to call it that, and also talking about that. We call it walking the talk. Companies that are doing well on those metrics and also incorporating that into their story, into their strategy, into their messaging, actually have, and this is work we did with the Wharton School at the University of Pennsylvania, actually have a 4% higher return on invested capital than the others. And so I think that what we need to get to is the recognition that companies don't do things because they're nice to haves. That the reason companies do things mostly is carrots and sticks. Either carrots, which is they're going to make a profit, they're going to grow their business, they're going to succeed, or sticks, which is the regulators are going to get mad at them, or the press or whoever else is if they do it wrong. Companies rarely do things purely for charity, and charities do things for charity. And so the goal I think that we've got to get to is get out of this trade-off mindset of, well, are you going to make money or are you going to serve your stakeholders? That's a ridiculous trade-off. The question really is, how do you do those things that you want to do? Call them ESG, call them whatever you like, that actually affect your business, because the world is changing. And as we go forward in time, we all know customers are going to want products that are greener, and people are going to want to work at companies that are considered strong contributors to their communities. It's a business imperative. And I think that's the mindset that is beginning to come into the fore in many places, and is the one that is going to succeed over time. We're not going to do this because somebody is telling us we have to. We're going to do this because we want to win in the future. And the companies that are going to win in the future are going to be sustainable companies.
And that's definitely, I think, the mindset that we see amongst a lot of the organizations globally. And in spite of some of those economic headwinds, really are doubling down on some of the actions that they're taking, recognizing if it comes to the climate crisis, or some of the social pressures and challenges, you're not seeing any step down in the level of ambition, partly because the issues are really starting to bite, even from a financial perspective. And certainly when you look at things like supply chain vulnerability and the action of the regulatory community starting to really require some quite strong action. In terms of you're based in the US, I know that a lot of your work is with global investors and global companies, but from a US perspective, how are you seeing some of the different trends and pressures that are making it either easier or more challenging for companies and investors to take action?
Well, I think unfortunately everybody probably knows that the US political system is quite polarized these days, and the idea of ESG has become politicized. We try not to actually use that word anymore because we haven't really used it much, but because it means so many different things to different people. So the way that I would put it is there was actually a great quote that I saw from the CEO of Delta Airlines, and I may not get it exactly right, but it was something like, anyone who thinks that stakeholders are not an issue is not running a large company. So the companies have moved. I mean, the idea that you wouldn't think about your customers, your employees, the planet, your communities, that's what CEOs do all day. They make these decisions and these balances and try to keep all of these constituents happy. They don't sit around all day thinking about their shareholders. They really don't. That's not their job. So the big companies, this train has long ago left the station. But there is political pushback in the US, and as I'm sure you know, the US is a litigious society. And so I think that what we are seeing and are expecting to see over the next, couple of years, I would guess, is increasing press coverage of some of these issues and increasing legal actions around some of these issues. And I do believe that that will make people more cautious. It's a little bit different to say, to make a statement and then be held to it in a court of law. And I think that we've shifted from companies all the time say things that they couldn't prove. We're the best company to work for. Okay, how are you going to prove that? But you can't prove that. But companies have made those sorts of statements for years. But what's happened now is people say, well, we're a green company, or we're this company or that company or whatever. People are saying, well, prove it to me. And if you can't prove it, then you're greenwashing. Then I'm going to take you to court. Then you're misleading your investors, et cetera. So I think that's the stage that we're in right now. I have absolutely no doubt that the trajectory of the journey is very clear. It's just that there are going to be some twists and turns and bumps along the way, and that particularly in the United States, the issue of fiduciary duty is extremely important. And sometimes I hear people around the world dismiss that in some way, and I think you dismiss fiduciary duty at your peril in the United States. The last thing I'll say on this, and this is going to be a plea actually, is I think we, and I'll include myself in this, as sort of a sustainability community, have done a poor job of marketing to the Americans. And so I'll just give you the simplest example. We often talk about 1.5 degrees Celsius. We don't use Celsius in the US. It's not that people don't understand what it is, but imagine if I, as an American, ran an advertisement in the UK and I used Fahrenheit. Like, how would that sound? It would just sound tone deaf, or you didn't know your audience. So I would encourage everybody not to say, it's really important to keep our emissions down to so that we don't have warming more than 1.5 degrees, to make sure that we align with the Paris Climate Accord. Okay, I hear that, some sort of statement like that all the time. What it is how are we going to keep our emissions down to make our planet a better place in the future, to have energy security, to have independence, to have competitiveness? Those are the sorts of words and mindsets that capture the American mind much more than things that are not there. So I would just ask people to think about marketing to the American messaging a little bit more.
I think that's a great point. And certainly, even though I might have grown up on Fahrenheit, there's definitely been that shift to Celsius. And so I confess that I can no longer do the translation very easily. So in terms of just coming back to that, I think the point on fiduciary duty is one that's obviously been discussed for a long time. But as you highlighted earlier, actually there is pretty compelling evidence that there's a fiduciary responsibility to take into account some of these issues, because they do have very clear financial impact, and I think that for a lot of organizations that's definitely a really key driver. One of the things that you see that clear link is when it comes to resilience, and climate change is one of the drivers that organizations are really looking at in terms of the physical impacts and risks of climate. Is that something that you've seen some of the investors and companies you work with looking at how they can factor in those increasing physical risks more effectively, and also some of the broader resilience drivers? So you saw with the pandemic some of the resilience that wasn't there, frankly, in terms of supply chains. So how are organizations thinking about that question of resilience, the energy crisis now?
Yeah, so we actually were in Singapore just a couple of weeks ago and had a session on exactly this topic with GIC, the government of Singapore's investment arm, one of their investment arms. And what we're seeing really very clearly is that companies are looking at resilience differently than investors are. And there's a tension there. So as an example, investors tend to be diversified among hundreds of companies, maybe thousands of companies. So the resilience of one particular company matters less to them than it does to the company, right? If you're the CEO of a company, you care a lot about the resilience of your company. But if I'm an investor and I own 1,000, I don't care as much. But what's happening, so historically, companies have sometimes been accused of padding their balance sheets, having too much cash, whatever it is, to protect themselves, to be resilient, and investors have pushed back on that. I think what the shift is now is that if you're thinking about resilience to something that's more systemic, then it does affect the investor as well. So if you think about climate, which is systemic, or if you even think about, inflation or rates, which are much more systemic, then that resilience conversation becomes much more of a mutual benefit conversation than I can diversify a specific risk away. As an investor, I can diversify a specific company risk away. So I think that the question that both investors and companies need to answer well is, how do they show that they're building resilience for the future that will pay off over time, or hopefully it doesn't pay off. Like hopefully you buy an insurance policy and your house doesn't burn down, but that it's prudent resilience rather than resilience that the investor can't diversify away. And I think we are one of the things that we've thought about a lot is that in an investment mindset is we've all been taught about risk return and the efficient frontier, but we're thinking increasingly about sort of, if you will, a three-dimensional efficient frontier of risk return and resilience, because the way risk is measured, at least in an investment context, tends to be very short-term volatility. And so a lot of that resilience point has been not measured. And so how do you recast a portfolio to really take into account that resilience? And there are things that you can do. You can think about, its emissions to be as simple as possible, or a lot of other things, but really shifting to that more three-dimensional view, risk, return, and resilience, we think is what large sophisticated investors will be doing over the next number of years.
Yeah, and I definitely think that there has been a growing recognition of, as you say, a more systemic type of risk, and therefore need for more resilience from an investor perspective. I remember a roundtable that we had with Mark Carney quite a few years ago, ahead of the TCFD being announced, and it was at that point where we were talking about from a financial regulatory perspective and financial stability, and how some of the climate change issues might impact on financial stability. And it was a very similar kind of conversation, and a shift in thinking of looking at some of the markets as a whole and recognizing, as for an investor, for a regulator, you're looking at the market as a whole, that actually some of that systemic risk did exist. There's also some interesting work that Cambridge University has done, which again highlights you can't hedge for all of it, so you need to tackle it head on.
That's right.
Thinking ahead into 2023, we're nearly at the end of 2022. I'd love to get your thoughts on the key things that you see on the horizon, what companies and investors are focused on and should be.
Yeah. Well, I think the first thing is the backdrop of turbulence. So there's no question that this generation of leaders, have not seen a war in Europe. They've not seen inflation at these levels. They've not seen some of these things. So I think we just have to recognize that many of the leaders of investment organizations and companies today are navigating through things that are uncertain and unfamiliar. Having said that, the big three things that we're working on right now, which we think are really important, the first is, how do you decarbonize assets, and how do you get money flowing into real world decarbonization? There's particularly in the investment world, there's been some cleaning up of portfolios. But if I clean my house by throwing my trash in my neighbor's garden, that does not help us. So the question is, how do you have real world decarbonization, and how do you drive that with capital? So we're working on that issue. We're also working on the idea of investing in employees, which is during COVID, every CEO said our employees are our most important thing. We care about the health of our employees. We're now seeing layoffs because the economy is softening. So how do we think about and how can we shift from employees as an expense, a cost, let's get rid of them, to how do we invest in them, just like you would invest in R&D or other things? Because we know how important talent is, that people are not just cogs in the machine. And then the third thing we're thinking a lot about, which we always do, is how do we encourage capital markets to reward long-term behaviors instead of short-term behaviors? So those are things like remuneration, the way contracts work, sort of the plumbing, if you will, of capital markets, and trying to shift those behaviors to reward that long-term behavior rather than just the quick hit.
Yeah, I'm picking up a couple of those threads. Certainly, as you highlight, it's easy to say people are our biggest asset, but then how do you really take the kind of actions and build into the strategy and the decision making? We've done quite a lot of work on human capital and social capital. One of the elements that we've seen coming through there is not only thinking about the employees within your own organization, but actually thinking along the value chain and the dependence that you might have on people throughout the whole set of your activities, including through to your consumers, which I think again is something that reinforces that point on longer term decision making. So yeah, in terms of just one final question. Throughout the summit, we've been looking at some of those challenges around people, nature, and climate, around some of the developments, including reporting, but also the broader developments. And on the final day today, one of the key areas of focus is thinking about solutions and actions. You've touched on a couple of the thematic areas that you're focused on. I'd like to just close with your thoughts on where you see some of the most promising actions and some of the really tangible examples that you're seeing coming to the fore that others might be able to learn from.
So we have always thought about the levers of long-term value creation, which is what we think is completely tied to sustainability, as being 5. Governance. It's you can't have a long-term organization with a short-term board. Incentives, the investor corporate dialogue, which we've talked about, metrics, which we've talked about some, and public policy, which we do less of because public policy is hard in one country, we're in 14 countries. So if I think about each one of those things, what I'm excited about progress we've made, but also where there's more to do. The first, is governance. I think if we were having this conversation 5 years ago, many boards would not be talking about sustainability. That would not be an issue in their boardroom. I can't imagine that there's a board in the world now, private company or public company, that is not having this on their agenda in the boardroom. And that mobilizing all those people to think about how this issue is relevant for them that's just an enormous power. So I think that's the first thing is governance, getting this front and center. We talked some about metrics. I know there's been a lot of work on metrics. You've done a lot of work on metrics. We've done work on metrics. It feels like we're getting momentum. I hope that we don't confuse too much disclosure of historical facts, which are numbers that are real, that have happened, with projection of future aspirations. And I think sometimes those two things can both be under metrics. I think, and again, I grew up as an investor. So investors like numbers that they can count on, but they also like to see ambition. And so my concern on the metric side is that we temper ambition by wanting too much disclosure. So I hope we walk the right line there, but we've come so far. In terms of the investor corporate dialogue, that's also a place that has so much changed over the last few years. Now, I know many companies get frustrated because they talk to investors and they hear very different messages from different investors. And sometimes they hear very different messages from different investors within the same firm. And that can drive people nuts. I know this. But again, it's a conversation in the room. 5 years ago, if somebody asked about their sustainability strategy, many CEOs would have looked kind of confused. They all know what that question is now. So I think that's huge. And then the on the public policy front, obviously public policy is divergent around the world, but any good company or any good investor is saying to themselves, what might the public policy in whatever country I operate in hold for me? And maybe it's disclosure, maybe it's a carbon price, maybe it's a restriction on this, that, or the other thing. So people are planning for that. And I'm a big believer that investors and companies typically lead public policy rather than the other way around. I don't think we can sit around and wait for politicians to solve our problems for us. But I think that anticipation and that sort of scenario planning is very, very helpful for companies. And yeah, the public policy will be different in different places, but big global companies will have to deal with the whole menu of that. And so they're thinking that through. So I'm actually extremely hopeful in this time. And I understand we've got economic headwinds and I understand we've got an energy crisis. But again, the direction of travel is very clear, which is to a more sustainable world, both because it's a world that we want to create and leave for our children, grandchildren, et cetera, and also because it is how we're going to create long-term value for our shareholders, our employees, our customers, our communities. And that's what businesses and investors are trying to do.
Fantastic. I couldn't agree more with that summary. I think a huge number of the points there really resonate with the work that we're seeing, really focusing on that ambition as well as the track record and the evidence that you have delivered is a really critical balance to achieve. And I think that's a really nice note to end it on, that focus on opportunity and the excitement that I think there is of the opportunities and the solutions that people can invest in to create a better world for all of us. Great. So thanks a lot, Sarah.
Thank you, Jessica, and thank you for all the work that you do in this space. We're a huge fan of A4S and so appreciate being included in this conversation.
Thanks a lot.